Something that came to mind too is diversification, right? So liquidity, complexity, diversification. Some of these private investments, these alternatives, are more diversified than others, right? Some of them are just a single standing asset. You're building an apartment complex in Florida, or you're building one in Texas. They're just a single family built for rent community.
Mm.
Others of our alternatives can get more diversified where you can put 100 of those investments inside of one fund. So that would be a more diversified approach. So it can be, from a diversification standpoint, there is a spectrum between a single family or a single multifamily asset and a fund that has 50 multifamily assets. One's more diversified than the other. However, neither of those really compare to the Russell 3000 or, again, another public traded company. So I always say when you step into this world of alternatives, yes, it's more risky. We hope to get more reward for taking that risk, but it's less diversified by nature. And that could be a good thing too, right? That's the scalpel approach opposed to just the sword. So there's a pro and con for each of those. But I would say even if you only had one asset, there could be a really good story behind that asset, right? And that story could very simply be somebody else built it and they got caught up in some financial distress. Maybe COVID happened that they weren't prepared for. Maybe the bank took over that asset. Our partners are so well connected in the spaces they operate that there are some opportunities that come up. And even though it may be one asset or five assets in a fund, there's sometimes present an opportunity to seek that higher reward, even though it's less diversified and less liquidity.
Right. So there's nothing wrong with the real estate. There's nothing wrong with that warehouse. There was nothing wrong with the hotel as a piece of real estate. Where it's located, the actual structure, or the buildings that we visited downtown New York. There was nothing wrong with those buildings. In fact, the prior owners had put so much money into those buildings, but the problem came when their financing came due, interest rates went up, and they could not find a financing solution.
They didn't have deep pockets to get through some hard times.
Or maybe they did have deep pockets and they just thought, let's not keep throwing money, good money after bad. And